Ladies and gentlemen, good morning. After a week rich of exchanges on best practices, convictions, and ideas, it is my pleasure to welcome you to this first plenary session of the last day of the Building Bridges Week. During the time we have together, we will discuss with representatives of asset owners how to implement in practice some of the things we heard when we deploy the capital savings in global financial markets. For decades, we have all benefited from a free lunch on the back of our planet. And as investors, we all know there is no such thing as a free lunch. In financial terms, we now realize we accrued enormous debt vis-à-vis essential ecosystem services, the carbon and water cycles, land systems, and biodiversity. We have responded by requesting multiple extensions of this debt, rolling repayment further and further into the future. Planet Earth is now giving us increasingly frequent margin calls in the form of extreme weather. Heat waves, forest fires, floods, and droughts. Like financial debts, the longer we put it off, the higher the ultimate costs. But unlike financial debt, there is no central bank for nature. No financial institution can intervene overnight to draw down carbon from our atmosphere, print more healthy soil, or inject water where it is needed most. The cost of these externalities has not been priced and is still lacking today effective pricing mechanisms. However, some of those costs are already coming in indirectly to bite us in our portfolio companies in the form of rising insurance premiums, fines, litigation risks, inflated input prices, stranded assets, or the physical costs associated with environmental disasters. So identifying the winners and avoiding the losers of the transition requires new data. Solving the problem requires new partnerships and out-of-the-box thinking, and this is why we're here gathered today. This morning, we have convened asset owners who, on behalf of their beneficiaries, often represent the ultimate decision makers allocating capital directly or through asset managers to global financial markets. As custodian of world savings, asset owners and managers alike have a critical role to play and a tremendous power to accelerate the transition. Yet, surprisingly, there is still a heated debate taking place opposing fiduciary duty and sustainable finance, as if doing good and doing well was a mutually excluding choice, ignoring the possibility that perhaps over the long term we can do better by doing good. It is our conviction that incorporating sustainable finance in our investment decision process is part of our fiduciary duty, because environmental, social, and governance factors do have an increasingly material impact on the valuation of our investments. Unlike 20 years ago, this information is now public, visible, and immediately sanctioned by the market. So there is a strong rationale to argue that our fiduciary role as invested has not changed, but it's rather the input necessary to deliver optimal risk-adjusted returns for our clients, which has. And if we look at the opportunity side, after the Industrial Revolution, the technological revolution with the advent of internet, there is the energy revolution which is happening. The only question is how fast. So as asset owners and managers, together with their ultimate beneficiaries or clients, we must decide whether to embrace this long-term structural trend, which is certain, and seize the opportunity, or dig our heads in the sand and continue to focus on the short term. Then comes the question of implementation, the how. The global asset management industry today represents 110 trillion of assets globally. This community is increasingly aware of the need to invest in line with the transition to print a more resilient and sustainable economy. But reconciling this with often ambiguous definitions, diverging regulatory frameworks, and implementation complexities can prove quite challenging. Fortunately, 60% of those assets, or 67 trillion, is in the hands of active managers, which could potentially, for part of it, direct their investments towards impact, towards sustainable strategies, or towards transition portfolios. 25% is in passive, which represents a growing share of the savings pool, and 15% is in alternatives, a major part of it in private assets, which can have a critical direct positive impact. So some of the questions the panel will try to address this morning is how to roll out sustainable finance in public versus private markets, liquid versus illiquid markets. What are the different approaches we can take in equities or in bond portfolios? What can be done with the passive part of our allocation? How to free up ourselves from the tyranny of standard benchmarks? And last but not least, active ownership, engagement versus inclusion, or how to be most effective as a shareholder and also as a creditor. Niall Quinn, equity partner at Pictet Asset Management, will now moderate the session. Niall, the floor is yours.
Thank you, Laurent. And good morning, ladies and gentlemen. Thank you for joining us today. We are going to have quite a tour d'horizon conversation amongst this august group of professionals we've gathered, truly representing best in class in terms of asset owners. And if I could offer a definition at this point, when we say asset owners, we're trying to bring a human face to finance markets and capital. We have representatives here both of a pension plan and an endowment. These are people who act on behalf of other people, delivering whether it's pensions or good outcomes in society. And I think it's worthwhile to be reminded that the capital we talk about, the finance we want to bring, isn't faceless, and we've representatives of those organizations here today. And we then also have organizations who help us develop the capital markets, the tools, the instruments, the regulation, and bring the research to help us make those decisions, and who can also coordinate us together, because no one organization or person can make a difference in this endeavor without cooperating with others. So without further ado, let me briefly introduce our panel. I'll then let them introduce themselves to you in the context of what they do, their organization's mission and purpose, and how they consider this space. We'll then begin our conversation, and I will try to allow between at least 5, if not 10 minutes at the end to address your questions. I expect on the basis of our conversation you'll have some. So may I start from actually the extreme left, our colleague Andreas Ernst, who is Head of Endowment, Responsible Investment at Constatter. Alongside Andreas, we have Sonia Gibbs, who's the Managing Director, Head of Sustainable Finance at the IIF. Aaron Bennett, who is the Chief Investment Officer of the University Pension Plans of Ontario. And last but very much not least, Stephanie Pfeiffer, OBE, I should say, CEO of the Institutional Investor Group on Climate Change. But Andreas, if I could ask you to start, and then each in turn, as I say, to describe what you do, your mission, what your organization's intent is, and how you think about this arena.
Okay, this works. All right, so I work for one of the largest foundation endowments, even if you don't know the name. So the family that is behind that has been operating behind the scenes, spending annually a couple of $100 million. I can't disclose sort of the amount of the endowment, but spending rate about just below 5%. Which is normal sort of in the US context, but in Europe that's sort of on the higher edge. My background sort of, I've been on this relatively recent, which allows me sort of also to take a fresh look at this. I've built up sort of the direct investment platform of that endowment, sort of focusing on circular economy, real assets, so we have a big chunk of that. So now I've taken sort of a fresh look on the investment endowment. We can talk about sort of some of the main insights that we're building on that. Yeah, I think maybe some more background, sort of 7th generation family behind that. We've considered ourselves as mission-aligned investors and investors who are, have always been sort of at the forefront of responsible investing. But that also means that you have to constantly sort of redefine yourself.
So the Institute of International Finance, we're based in Washington, D.C., but our members are global. So 450 members, 70 countries. Over half of them are from emerging markets across the sector. So, asset owners, managers, banks, insurance companies, pension funds, sovereign wealth funds, consultants, lawyers, lots for our sins. If we had a crest of arms, the IIF, it would say 2 things. One is, please have international alignment in policy and regulation so that we have common rule books that work across borders. And number 2, support and maintain stable capital flows to emerging and developing economies. That's been our mantra for 30-odd years. We do a lot of work on capital flows and local market development in these countries. And the 2 are very related, and also related with the topic of sustainability. I mean, to me, the debt policy agenda and the sustainability policy agenda are very interlinked and becoming increasingly so.
Aaron Bennett from the University Pension Plan of Ontario, or UPP for short. Some of you may not have heard of us. We are the new kid on the block in Canada. We're only 2 years old. We were designed by and for the university sector in Ontario to manage the pensions of both faculty and staff. We are essentially implementing our version of the Canadian pension model at a mid-size format. And for us, that means that you're going to look selectively to internalize certain things, to add governance and have arm's length governance in the management of the pensions. One of the areas we've specifically targeted for internalization is what we term responsible investing, but I think in this context applies as sustainability. And there are a number of reasons we do that. One, it's important for our stakeholders across the existing $12 billion in assets that we currently manage. 2, because as the CIO who manages the investments, I explicitly believe that is to our advantage in capturing returns and managing risks on behalf of our members, which makes it firmly aligned with our fiduciary duty. So there is no trade-off between those 2 in our mind. And finally, it's because all of our members, our trustees, and everyone else had gotten together when we set out from the beginning and laid out a statement of investment beliefs where we explicitly acknowledge that our investments have an impact on systems in the real world, and our investments rely on a functioning real world in order for us to produce the kind of outcomes that we need to on behalf of all of our members.
And hi everyone, I'm Stephanie Pfeiffer from IGCC. IGCC is actually a membership body for investors, and we bring pension funds and asset managers together. We have over 400 members now with around 60 trillion euros in assets. And our mission is really to help investors act on climate change, to address the risks and opportunities, but in a way that has most impact in a short framework by 2030, and to have as much impact on the real economy as possible, so that we do support a net zero and resilient economy. We really work in 3 different ways. One is working with investors to help them set their ambitions, help them raise their capacity. So for example, we set up 2 of the net zero alliances under GFANZ, the net zero asset managers and the Paris aligned asset owners, to ask investors to make those commitments. We also help develop frameworks and guidance that we do with investors. All of our work is investor-led. So we develop the net zero investment framework to really help guide how you implement those net zero commitments. And we think a key way to manage risk, but also to have that impact, is through corporate engagement. And so we have quite a long history of supporting investors with their corporate engagement activities. We helped to co-found Climate Action 100 Plus, which of course now has over 700 investors engaged with over, I think it's something like 70 trillion in assets to work with the highest emitting companies to reduce their emissions and to invest in climate solutions. And more recently, we added the Net Zero Engagement Initiative to that to add more companies, also starting to focus on nature, and recently set up Nature Action 100, which now has 200 investors signed up to it. So corporate engagement, really, really key part of what we do. And then, of course, we recognize that you can't meet these ambitions on your own. And so engagement with the wider ecosystem, but particularly with policymakers and regulators, is really, really important. So we try to bring the investor voice together as well on issues such as carbon pricing and what you need to do more to invest in the solutions, but also, how do we mandate that companies have to disclose in a way that investors are really able to measure whether they are walking the talk. So I think in terms of fiduciary duty, we have to take the long term into account, and we won't be able to pay out pensions over the long term if we don't address the issue now.
Thank you, Stephanie, for bringing the intro to a close. And I think it's a very good point to move to the practical. And Aaron, if I could start with you. What we just heard in summary from Stephanie is that there's a lot of commitment from asset owners and people such as ourselves on your behalf, and organizations like IGC and IIF to make this happen. You have to make it happen every day across an entire portfolio of assets. Could you talk us through what that reality is for you today at UPP? What works well? What's a challenge?
Absolutely. So we have it integrated across all of our investment processes, so it's not a separate process or a separate allocation to assets. So the responsible investing team is part of the investment team. Every time we choose a manager or make an investment, they're involved. The output of their work is presented to myself or whoever the appropriate governing body is. That being said, we cannot apply these things all in the same way or with the same level of intensity. We need to focus in certain areas. We focus particularly on some areas that we believe have systemic impact, which is to say impact on broader systems that would be difficult for us to avoid as a financial player. Climate is one. The other one that we're currently working on is equity, diversity, inclusion, and reconciliation. We apply these across all of investments, but we apply them in different ways, and we do find challenges. We find in active investing in public equities, private equity, infrastructure, and real estate, we see a lot of opportunities to engage with managers to make specific investments that can be very clearly aligned with what we're trying to achieve across the portfolio. There are other areas, however, where we see a number of challenges, either because of the availability of products or some of the constraints within our portfolio. Sovereign bonds is one. As a Canadian defined benefit pension plan, we own a lot of Canadian bonds. We are subject to what the Canadian government issues, and we need to work with the Canadian government, and we do have elements of policy advocacy, but as a $12 billion fund, we have somewhat lower influence than perhaps some of our peers with hundreds of billions. And then another area where we find some particular challenges, although we've actually seen some really interesting opportunities recently with regards to innovation, is in our absolute return strategies or hedge funds. These are a diverse group of assets that we look at just to be an offset to the regular public markets. Some really interesting opportunities here. Very difficult to apply conventional sustainable investing thinking to some of these because of the nature of the strategies, but also some really interesting opportunities to build capacity and advance the cause in an area that is becoming increasingly important for multi-asset portfolios.
Thank you, Aaron. And could I direct that question to you, Andreas, as well? Aaron's obviously thinking very much long-term, has commitments to pay out pensions. You have commitments on an annual basis to pay out for the endowment. So how do you balance competing factors, if you view it that way? And how is it in reality for you with the assets that you manage? What works well? What's more of a challenge?
So the one thing that is easier for us than for Aaron is that in terms of the constituency base is one private foundation, so there are two topics that are important. Climate change mitigation and adaptation, as well as human dignity, sort of being based sort of on a faith-based tradition. In terms of how we manage that, I mean, I already alluded to the fairly high spending rate, which means we are sort of, in European terms, heavily tilted towards equities. I mean, you may know that sort of French, German foundations, Swiss foundations traditionally are very heavily sort of on focused on fixed income. So here, very much focused on equities. Big chunk on private assets, and to get sort of the current income out of there, sort of traditionally a lot of real estate, shifting now a lot into real assets. And then on top of that, sort of private equity, private debt. So I think that's what puts us apart sort of on the asset allocation side in the European context. So it resembles more sort of a US-like endowment from the asset allocation side. I think what puts us apart is that we sort of transitioned into sort of a direct investment approach through, like the Canadian model, sort of through co-investments, and then sort of finally sort of developing our own direct investment sort of capabilities on the private equity side. The other thing is that we try sort of to take a holistic approach. So we also do PRIs, so program-related investments on the expenditure side, which allows us sort of to leverage investments on, even if they're small, right, on the expenditure side. Where do we see the challenges? I would say, obviously we're always grappling with that sort of fiduciary duty challenge, because for us it's really twofold, right? A fiduciary duty for us is, as you said, Aaron, as well, is enabling the philanthropies to honor sort of their commitments, in perpetuity and in real terms, as well as being mission aligned, right? So we don't see that there's a linear, and maybe that's a sort of a little bit controversial, we don't see sort of a linear correlation between responsible investment and financial performance. So when we sort of started 10, 15 years ago with the divest movement at the time, we were initially sort of rewarded. And then as the room became more crowded, it sort of the performance of that was affected as well. So for us, that doesn't mean that RI is negatively correlated at all, but it means that you always need to look for the empty rooms, or with other words, sort of look for the edges. And where are the edges? The edges are, either somewhere a first mover, although then you need to question sort of, what's the execution track record on that first mover, sort of using some sort of alternative data. So we're constantly sort of looking for the edges. We, on the hedge fund side, we use sort of a lot. We are actively sort of pursuing or looking for sort of convexity strategies in the field of, for example, climate insurance, right? So we have very much so proactively embraced the topic of for adaptation, right? So not just mitigation, but also adaptation. So there are interesting plays on the convexity strategy side that we've embraced.
Thank you, Andreas. And one of the things I reflect on in listening to both you and Aaron, we've talked already to a degree about equity, whether public and private. You both talked and effectively implied in that, there's an element in this which is about engagement. It's also about control, frankly. I'd like to move on, I think, to Sonia and then Stephanie in turn. One of the things in a workshop that we participated in together yesterday that really struck me, it is something that Aaron touched on in reference to Canadian sovereign debt, is the outstanding stock of debt in the world today, which has increased by $100 trillion in a decade, is $307 trillion. Equity markets, public and private, are a fraction of this. And we don't seem to have the same level of conversation as yet about fixed income and credit and how that's part of the solution away from divestment in the journey to transition that we're now talking about. Sonia, I'd love to get your thoughts on that.
I think it's going to be one of the biggest challenges of the next several decades is creating this enabling environment for transition finance. It's moving beyond the question of sustainable finance. And again, that gets to the taxonomy question again. But you've got a number of kind of preconditions that have to be met for this to happen. And they center on the policy environment, the regulatory environment, the political climate, the development of transition finance markets, and the challenges of incentivizing good governance and a hospitable investment environment. Without those conditions in place, we can't get to the scale we need in sustainable or transition finance. A note on the policy environment. And one of the things we hear most frequently from our membership is that the financial sector cannot do this alone. We are supporters and enablers of transition. We are not drivers of transition. To truly support this kind of transition investment, I mean, look at what Janet Yellen in the States did. She released, transition investment principles. But governments need to have good policy in place with respect to things like pricing of carbon and other negative externalities, incentives for environmentally friendly investments, and incentives to change corporate and consumer behavior. It is not the responsibility of the financial sector to dictate what those changes should be, but rather to support and intermediate funds so that they can happen. So in an ideal world, we'd have a lot greater alignment amongst policymakers in groups like the G20 Sustainable Finance Working Group. But in the absence of common global policies, that's where regulation comes in. Everybody looks to the regulatory levers in areas like disclosure, taxonomy, prudential supervision of climate and transition risk. I think taxonomy is one of the most difficult questions here, and it really affects what investment managers and asset owners can do in terms of their investment, because it's intensely political. We've had a huge proliferation since the EU started its taxonomy in 2018. We have over 20 states and regions now that have their own taxonomies, plus those established by international organizations and so on. So it's a minefield, and we're not going to get to an international taxonomy standards board like we did with sustainability disclosures. It's just simply not going to happen. So it's the world we have to live in. It's also a good example, taxonomy, of how politicized some of these issues can be. Taxonomy is a very political issue, as is disclosure. I mean, look at the US, where the US Securities and Exchange Commission has been having great difficulty getting its rules through, partly because of political pressure. Look at the disclosure legislation in California. California is taking an entirely different approach, and it just reflects how very political these issues are. On a hopeful note, sustainable finance markets are continuing to grow at around $5 trillion now across loans and bonds, the ESG debt universe. It's more than double what it was just 2 years ago. And then the net zero commitments that companies and countries have made are going to continue to drive this. Huge, huge potential in these markets. Green mortgages to blue bonds to sustainability-linked loans. I think I would highlight here, though, that integration of ESG into emerging markets is a far earlier stage. And that is a constraint on what we're all trying to do here, which is mobilize climate flows to emerging and developing economies. So the last point I'll make is on the importance of the investment environment in these countries. In many cases, you have weak legal or regulatory frameworks, you have political uncertainty, you have economic instability, foreign exchange rate risk. In order to really scale investments, on a global level, that has to change. And to me, maybe one of the most promising things and we've heard a fair bit about this here at Building Bridges, is the growing prevalence of kind of direct communication, direct interaction, engagement, stewardship, call it what you will, of the private investor community with emerging and developing economies at the sovereign and corporate level. So it really enhances the work on capacity building that the World Bank and other multilaterals have tried so hard to do over the years. So that's a really positive aspect of all of these discussions.
Thank you, Sonia. A lot to unpack there, but I think a lot that we would reflect on as investment managers. We manage a lot of exposure to emerging markets, and the reality is many investors have been substantially underweight for the best part of 7 or 8 years, and for reasons that might just be simply related to their view of relative returns and risk, they're not investing. You've probably touched on some of the issues why that might be part of the reason why they're not investing, but it's something we do need to address in order to get those flows to come back in a natural way. Stephanie, if I could come to you, I was struck by the fact that both of our asset owner organizations have quite similar agendas in the sense of both agree on climate change, and if I could correlate to some extent human dignity with DE&I, when you deal with the, I think, 700 members, how often do you find that there's that strong correlation when you're trying to coordinate our activities? And I'm thinking now particularly in public markets, right? The very visible public companies, if I was to put a name out there, Exxon, for example. Is that normally what you experience, and how do you clear the market? How do you build a coalition?
I mean, with 400 or so investors and then many more in the different initiatives that we've co-founded, I still feel that there is a huge amount of momentum, and that's sort of what we try and harness. And perhaps but it's very much also asset owner driven, demand driven. So what happened in 2019, it was actually asset owners that approached us and said, look, we're asking companies to make net zero commitments. We've got governments, 197, I think, who have signed the Paris Agreement. What can we do as asset owners? How can we make a net zero commitment, and how can you help us define methodologies across our portfolios? And so what we did is actually we brought together those asset owners with asset managers to help build what became the net zero investment framework. So it was very much that sort of collaboration between asset owners and asset managers to see what could be done. And so we sort of did NZIF 1.0, and if you look at it, it really looks at what strategies can investors set, and then how do you implement it across different asset classes. And on the back of that, a lot of asset owners, but also asset managers, then made their commitments. But it's very clear that it's much easier for the asset owners to do that because they're sort of the ultimate holders of the capital. When it comes to the asset managers, you look at, they can commit more of their portfolio if they're in certain regions and subject to certain regulations, depending on what kind of assets they hold, where the methodologies for alignment are already available. That makes a big difference, where the data is from. So you can really see, and then when the clients are asking for them to have that alignment, that's really, really key. Now we're sort of through the first phase, and we're sort of reflecting on what can we do better. And one of the interesting areas is that people feel that we've come at this very much from a sort of developed market kind of lens, and are we sort of disincentivizing perhaps investment in emerging markets, or is there perhaps too much of a focus on portfolio level emissions, and do we actually need to focus much more on that real economy impact? And so one of the things we're doing now is looking at, starting with sovereign bonds, is when investors are looking at methodologies and their target setting, how do you actually differentiate by countries and regions? They have to all decarbonize at different rates because you don't want to just disincentivize investment in emerging markets. And that means we have to work together with groups like the IEA, who define some of those country pathways. So it's really going back to what we've done, looking at it from a different, are we looking at emerging markets. Are we bringing in just transition? I mean, in the Climate Action 100+ initiative, we added a just transition indicator to the benchmark so that investors, when they engage with companies, don't forget that there is a social aspect. We have to really, unless the communities, the workers are behind the transition, we're going to run into roadblocks, and we've seen that many times. We've seen that in France with the Gilets jaunes. We've now seen that in the UK, where governments backtrack, and we need social support as well to really get through this transition.
Thank you, Stephanie. I think another insight into the complexity. And as you were talking, Aaron, I couldn't help but think of you. And you touched earlier on the fact that you have a mixture of internalization and externalization. For those for whom that might be jargon, so you're managing some portfolios with your own team in-house, so to speak, and then you might be employing external asset managers to manage some of the money. Let's imagine that's your public equities portfolio. Some might be active, some might be passive. How do you then normalize your view of that portfolio, taking account of your ambitions in climate change and DE&I? How do you feel like that's our pool of equities, and I know exactly what we're generating as positive outcomes as well as returns here?
It's a great question, and one that we think a lot about. And there's a couple of elements there. One, it's been referenced a number of times, the tyranny of benchmarks. We think of benchmarks, although we have conventional ones, the MSCI ACWI and the like for our public equities program. We think of our fundamental benchmark is, what is the purpose of our fund? And that is to fund pensions for our members. And so that means there's absolute return and other elements associated with that. They're far more important benchmarks for us. And then one of those other elements is our stewardship obligations, which we think support our ability to generate those returns within a reasonable risk appetite. Now, in active situations or internally managed situations, our ability to apply things like proxy voting and engagement, those are much clearer, or at least historically have been as such. I think increasingly we're starting to see some interesting movement towards the ability to apply some of those stewardship principles to our passive portfolio. For example, we now vote the proxies in our passive funds, which is a relatively new thing, but one that I think will increasingly grow with the interest in sustainable investing over time. We also have explicitly made regulatory and policy advocacy as part of our stewardship plan, particularly when it comes to climate change, because in our mind, that is the ultimate player. And I think Sonia and others have said before, is finance is a catalyst. We need other things to work. Anyone that knows anything about chemistry knows that catalysts require the other elements within the reaction to really work. Otherwise, you don't get the expected outcome. So we try to not have to make that choice between the two. There is still, around the edges, some harder choices to make, but we still think that there are growing opportunities on the passive and the active side to engage with the asset managers, to engage with the individual companies, as well as the regulators and the governments, and of course, as Stephanie was saying, collaborate with our peers to really have the desired impact on real-world outcomes.
Thank you, Aaron. I think a great example of what we've called in the title the new reality for asset owners, because this is a much more complex way of managing for returns in the modern world. I'm conscious of the fact that we are rapidly running out of time, and I would like to offer an opportunity to you, our diligent audience, to ask a question or two of our panel. So please, Christine, I'll allow you to select.
Can I respectfully burst the bubble a little bit? I think for Aaron's point on the Canadian pension funds, I think the Canadian pension funds do an amazing job on sustainability, but typically that's because there's a dual mandate in there, so it's embedded in what you do. I don't know if that's your mandate with this new pension fund, but generally it leads the way. What happens with many of the other pension funds is that they don't have sustainability in their mandate. So I know that there's some big structural issues, and policy and finance can't do that alone. That's been acknowledged. But in terms of this session here and low-hanging fruit, I would love to know from your experience, how do we push those asset owners that don't have the dual mandate to move forward on this. I know there's been a lot of work done on model mandates, but hasn't been as effective as it could be. Anybody that's worked with legal and mandates know that that's complex. So what's the leverage point to change those mandates within the constraints of the political system? And then my second question that I hear a lot in pension funds is obviously, I think, when this filters down from senior level down into operationalizing it, and those people that are selecting funds, investments, doing the day-to-day, there is still, I think, career risk for them in terms of going beyond their fiduciary responsibility. The default is to performance. So you have a 2 to 3 year timeline, and then it moves beyond it. So if we're going to mainstream sustainable finance beyond impact, what is it that's needed to give those people on the front line space to take career risk, to innovate? And I find it really interesting, having worked in a family office myself, that fiduciary responsibility comes up for you in the family office, given that the chain of the agency chain is so short. And if a family office is talking about fiduciary responsibility, where does that sit for the rest? Anyway, and I very respectfully, but I would love us to get a little bit more gritty about how we move forward on some of these.
So we are definitely going to try to unpack that for you. I know there was a gentleman to your right that had a question. So, sir, we'll come back to you because I think there was effectively, an observation, probably 3 questions. But Aaron, maybe if you want to take the Canadian aspect first, and then I'll open it up to my other colleagues here to try and address some of the, the agency and incentive. Perhaps could we call it that? But we will make time for at least another question.
Absolutely. So it's an excellent question. I would say first and foremost, in fact, most Canadian pensions, including my own, do not have a dual mandate in the way that you would conceive of it in European terms. There is not double materiality in Canada. That is not something that we have aligned with. What we are aligned on in Canada versus perhaps some other regions is what our fiduciary duty is and the role that sustainability plays in supporting that fiduciary duty. And that is funding the long-term payouts of the pension. So that enables us to broaden our horizons out both on the asset and the liability side. Actuaries for years have been forecasting out 20, 30, 40 years to assess your pension liability. So on the asset side of things, we do similar things. And broadening that horizon out and connecting sustainability to supporting what you're doing on the fiduciary duty gets you away from the shorter term focus, and I think gets you focused on these things. Now, I said that quite easily, but I also realize that it is not an easy thing to do. And in some jurisdictions, it is incredibly hard to connect the two. But I think if you keep the value creation, long-term value creation connected with sustainability, then you can maintain that connection with your fiduciary duty and get past that initial conversation, or at least have a better conversation with your trustees and your members around that element.
And just to add, it's a charitable foundation, so it's not a family office.
I just want to make one quick point. I think that's a terrific illustration of why one firm working alone without a proper framework will struggle always with that concept of fiduciary duty, returns, and social responsibility. If we had, for example, carbon pricing and pricing of negative externalities, and we understood the true impact of carbon emissions and the value of natural capital, if that were priced, sustainable investment strategies would outperform without question always, and we wouldn't have to deal with that question. So it's a great example.
And a very practical regulatory imperative. Sir.
Hi, my name is Juan Carlos Lara. By the way, wonderful presentation, congratulations. I have a question here, and I would like to be very pragmatic. To me, one of the biggest problems in the world is poverty. And if we understand that in order to fix poverty, which is SDG number 1, GDP has to increase, and emissions are 0.9 correlated to GDP, and resource utilizations is 1 correlation to GDP, meaning 100%. So how to deploy capital in a world where we want to go to net zero? understanding that to go to net zero, probably the better thing is not to emit pollution rather than buy financial instruments. So how do we address this situation? And how can we deploy capital to make the best possible outcome in this situation, given the reality that the world is going to keep on raising, is going to keep on increasing? Thank you.
Thank you. Who would like to take that very on point but complex question? Andreas.
Yeah, maybe sort of a niche or micro answer to that, but I mentioned sort of our real asset exposure, which we have sort of across Africa, Sweden, one of the largest wind farms, which we just launched last week, Republic of Georgia, where else? So anyways, the way we've looked at this, exactly the challenge that you just mentioned, is we were trying to look for countries with high economic growth, but low renewable energy, and so, but lower than average growth in renewable infrastructure. You see, so but to tackle those challenges at the same time. So on the one hand, sort of enabling growth, economic growth, but deliberately trying to prioritize countries or projects in countries where sort of the infrastructure was below average. I mean, it's a micro example, but sort of we thought about it. But I wouldn't know how to translate that sort of to a listed space.
It's an incredibly challenging question and a really important one as well. I think it does bring to mind the idea of the just transition and thinking about that. The impact of climate change will not be felt uniformly across the world, and I think it'll be felt disproportionately in regions where poverty tends to be higher, and the resilience overall of those countries tends to be much lower. So a just transition does include the overall transition and thinking about how do we break this correlation between the intensity of use of fossil fuels and economic growth. I think renewable energy and other elements are part of that. But it also means that you have to apply whatever taxonomy you come up with when you're thinking about investing in transitions. As I think Andreas alluded to, you have to apply it differently. You would apply it differently in Switzerland and Canada than you would to, you know, growing economies like Indonesia and economies in Africa as well. You cannot apply the same lens in those areas, and you need to think about what Sonia brought up, is how do you drive investment? Where is the opportunity there in the transition to really drive this just transition? So I think in many ways you can address some of the issues that you'd raised, but there is in the short term, a challenge of saying how you're going to do that as well.
Yeah, maybe just to add to that really quickly, I think it then goes back to building bridges between the investors and the MDBs and the project developers in different developing countries. How do we address that? What do we do about blended finance? How do we work with asset managers to develop the right products so that we can do more of that at scale? So I think it goes back to that ecosystem that we have to develop.
Thank you. And that seems a very positive note to end on. What were great questions. I'm encouraged because the people on this stage are actually thinking about the answers. Thank you for your participation. We look forward to continuing this conversation after this plenary session and obviously in the years to come. And I hope we have a similar conversation next year with a wider group of people. Thank you again for your participation. Thank you again to our excellent panel.